type of facility, even if it's adult daycare, which adult daycare can be popular if someone has Alzheimer's and it's pretty mild and a husband or wife's taking care of the other at home. You certainly still need a few days a week to get your hair done, do some grocery shopping, different things like that. And adult daycare facilities would be similar to a child care facility where you could drop that person off for the day, let them have care. I already mentioned help protect your assets. The other thing is, most people I talk to, I've been dealing with seniors my whole life, and many of them, their number one concern is to leave their assets to their family, their kids, and maybe not so much the kids, but at least the grandkids. And long-term care is one of the few things that can change those plans and wipe everything out. So it provides the opportunity for you to realize those dreams and leave a legacy to those grandchildren or children, and not having spent it all in long-term care. Inflation protection, we talked about that. Most of you look pretty young. I mean, I don't think anybody's in their 80s here. But with life expectancy moving up, even someone in their 80s could live another 15 or 20 years. And so again, if you buy coverage that's adequate for today, it's not going to be 5, 10, or 15 years from now, and that's what inflation protection does. It increases your benefit incrementally every year. Affordable extra protection. This is referring to John Hancock's newest policy, which only offers, and they still have unlimited benefits here, but they have a new policy that's a 3 or 5 year option. And you can take 3 years or 5 years flat, or you can take the additional coverage, which would be 3 years plus $1 million worth of coverage, 5 years plus $1 million worth of coverage. And a lot of companies are moving. I would guess that probably in the next 5 years, unlimited coverage won't even be available. And one of the reasons for that is, as our population is aging, if you buy 3 years worth of coverage, the company can work the numbers there. They know the maximum they're going to pay out. Even if you buy 5 years or 5 years plus $1 million, they know what their liability is. But when you buy unlimited coverage, wasn't it you that said your mother was in for 15 years? 15, okay, 15 years. You buy unlimited coverage, there's no way to tell how much you might pay out. And so the cost of unlimited is going up quite a bit over the last couple of years compared to 5 years ago, and many companies are starting to move away from that. Services to help pay at home. Many policies will offer to pay even a friend or relative to help, or sometimes we get help from church members. So a lot of policies will even pay a church member to go grocery shopping and do things like that so you can stay at home as long as possible. Caregiver support, respite benefit is one that I think of when you talk about caregiver support. They'll even pay for someone to come in if you are taking care of a loved one at home, and give you a few days off, a weekend off, that sort of thing, and have someone stay in the home with that loved one. I've kind of mentioned already, but coverage can be received anywhere, any setting, your home, community, adult daycare, hospice facilities, which are for terminally ill. And hospice is very good, and it's covered already under Medicare. But to give you an example, hospice nurses and care people are limited in areas. And it's a first come, first served basis. So if there's a lot of people needing hospice in, let's say, the Denton area, there may not be someone to come to your home and give you the hospice care you need, and they're also limited. They may not give around the clock care. So if they're going to give you 8 hours a day and you need the other the other 12 hours, these policies will coordinate with that and pay for hospice care. And then of course facilities, assisted living, and nursing home as well. Like I mentioned, this is John Hancock's newest slide, so the 3 and 5 year are the options that are available with John Hancock. But they still have the Custom Care 2 series, which does offer up to unlimited coverage. We have discounts, by the way, with Hancock, Allianz, and I believe it's MetLife. So those 3 companies, we have discounts available for DATCU members. But again, when we do a quote for you, we can spreadsheet it and show you the top 3 and look at every company. Total benefits, that's something I was describing earlier. basically, if you have a $4,500 a month benefit for a 5-year period, they're going to multiply the 60 months times $4,500 a month, and that gives you a pool of dollars of $270,000 that you can use for long-term care. $150 a day times 5 years. It's an example of the daily benefit. You can see it works out just a little bit different, $3,750 more in benefits. The big difference between the daily and monthly benefit is that with monthly benefits it's a little bit more expensive, but if you have just a few days of care you get the whole monthly benefit, where if you have a daily benefit program you're going to get paid per day. So if you have 5 days of care you're getting $150 a day times 5 days. Everyone follow that? Long-term care benefits can come in monthly benefits or daily benefits. You pay more for a monthly benefit, but if you had 5 days of care at home, you'd get a check for $4,500. Where if you had the daily benefit plan, you'd get 5 times $150. Elimination period. Most of the time we recommend about a 90 or 100-day elimination period. What that means is the policy is not going to pay for those first 90 or 100 days of an illness. But with Medicare covering 20 and then an additional 80, and home care is a little bit more liberal than it was 15, 20 years ago. So there's a good chance you'll get the lion's share of the first 50 to 100 days covered by Medicare, either at home or in a facility. And so the cost of your long-term care policy would be less if you take a 100-day elimination. Now you do have the option of going with 30 or even a 5-day elimination, but a lot of times you're paying a higher premium for benefits that you don't need. Automatic inflation, again, is the inflation rider I mentioned, where again your benefit increases every year based on the initial amount. So if you start at 100 a day, you have the 5% compound. It's going to grow by 5 the first year, then it's 5% of the 105, so it's compounded. This shows the compounding, and the difference is this. If you take $100 a day and it compounds by 5% simple, 5 times 20 is 200. So from 1976 to 1996, your benefit would double. You'd go from 100 a day to 200 a day. But with the compounding, because it's 5% of the higher amount every year, instead of having 200 a day in the year 1996, 20 years later, you're going to have $253 a day in benefits. So you have $53 more, about 25% more in benefit over a 20-year period with the compounding versus the simple inflation rider. There are limitations, but they're few and pretty straightforward. Will not pay for benefits in excess of the policy limit. So if you have that limit we talked about, a 3-year plan, you have $275,000 worth of benefits, that's all they're going to pay for. And that's with all companies. Will not pay for charges during the elimination period. That kind of makes sense. And then the last point basically says that if Medicare or any other government program or workers' compensation covers you or a car wreck, then we're not going to pay. But that means you're already covered. So it's a coordination of benefits, if you will. That's the end of the presentation. I'd like to open it up to questions.